This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Renovation Nation homeowners are pouring money into new projects. And Home Depot is coming out on top with a strong quarter and a stock at record highs.
Must own for your portfolio. The one stock our guest tonight says every investor should buy, whether you're just starting out or you've been in the market a while.
And making a splash, how the now viral Ice Bucket Challenge could forever change fundraising and charitable giving. All that and more tonight on Nightly Business Report for Tuesday, August 19th.
Good evening, everyone. Housing and Home Depot, those were the two big boosters on Wall Street today, adding to more gains for the major stock averages. Housing starts surged last month, and earnings went through the roof at Home Depot, making it the best performing stock in the Dow today. We'll have more on both those stories in just a moment. Well, investors were also in the buying mood thanks to encouraging news about inflation. Consumer prices rose just 0.1% in July. This is the slowest gain since February. A sharp drop in gasoline prices offset a rise in food costs, keeping inflation in check. By the closing bell, the Dow was up 80 points, the Nasdaq rose 19, and the S&P added nearly 10 points and is now just 0.5% shy of its all-time record close.
More now on that rebound in new home construction last month. It shot up nearly 16%, the most new home building since last November, with construction of single-family homes and multifamily units both up sharply. Now, even though housing starts surged in July, all housing data are not equal in the current recovery. Diana Olick explains why.
It was a welcome surprise from the builders. Housing starts soaring nearly 16% in July from June. It was well beyond what traders expected, and so the trades took off. Names like D.R. Horton, Lennar, Hovnanian, all climbing on the news. But it was these stocks, multifamily apartment REITs, Avalon Bay and Equity Residential, that hit new all-time highs.
People have been sort of downplaying the multifamily side because that's more volatile, but that's been a big part of the construction recovery. And when we look at the markets that are seeing a construction boom right now relative to what's normal for them, it's places like New York and Boston, San Francisco, Los Angeles, places where most of the new construction is multi-unit.
Single-family starts rose 8% month to month and were up 10% from a year ago. But multifamily, which is mostly rental apartments, jumped 33% month to month and nearly 50% from a year ago. Apartment rents are soaring with starts, but demand is still strong. The same cannot be said for the jump in single-family home prices, prices which are sidelining some buyers.
We are seeing a sort of boom in the housing market. So, we've got stocks and bonds highly priced, and now we're starting to see maybe housing going in the same direction. It's like everything is pricey.
The boom is in prices, not so much in sales yet, and that was a strategic move by builders.
It was a little bit too much too fast. I think the builders were trying to slow down their sales paces because they were running short on lots. They wanted to maximize their profit margins per house, so they said, let's raise our prices. It's the only natural thing to do, but they overdid it.
Now, going into fall, builders may take on a new strategy. D.R. Horton, in fact, already said it would start offering incentives to buyers to get them back in the door. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about the hot market for apartments, head to our website, nbr.com.
Now, another beneficiary of the housing recovery is Home Depot. As more Americans fixed up their homes and yards this spring, second quarter profits surged 14%. Home Depot shares rose more than 5% today, closing at a new all-time high, $88.23 a share. Courtney Reagan has more on what's behind Home Depot's strong earnings report and what's ahead for the do-it-yourself chain.
Retailers may be lagging, though it's far from the case with the world's largest home improvement store. Home Depot built another strong quarter straight through and all around, improving profit and sales above expectations, posting record customer transactions, strong traffic throughout the store and across regions, a stark contrast to many other retailers' reports. On the earnings call, Home Depot executives attributed the breadth of sales strength to new store layouts, including the core of the store, and demand for spring merchandise, as well as sales of appliances and high-priced services like countertop and window installation.
People had not put very much money into their homes during that housing downturn, and so you're still seeing this release of pent-up demand that's driving remodel activity and wallet share shift to the home improvement space.
While the housing market has been a driver for Home Depot, on the company's conference call, CFO Carol Tomei said she's most concerned about mortgage financing availability, though not everyone is worried.
The large majority of what drives Home Depot's business is non-mover remodeling. And as long as home prices are going up, we think that remains the key growth engine to this business.
Despite mixed signals from the housing market, analysts say the low interest rate environment will continue to give consumers a reason to spend on their homes. As a result, analysts from Credit Suisse and Janney think the stock market hasn't given Home Depot appropriate credit for consistently impressive results. But investors may have made up for lost time today, pushing shares to all-time highs. For Nightly Business Report, I'm Courtney Reagan.
Another big retailer topping Wall Street forecast last quarter, TJX. It is hot, hot, hot. The owner of the off-price stores like TJ Maxx, Marshalls, and Home Goods. Well, net income climbed to 8% on higher sales in the U.S. and abroad. And with the company raising its full-year earnings forecast, shares up nearly 9% today.
The earnings news at Dick's Sporting Goods not as strong. Net income fell 17% in the second quarter after the retailer cut jobs in its golf business on declining sales of golf gear and equipment. Still, Dick's beat analyst estimates and shares rose nearly 2%.
And after the bell, earnings from a company that makes products I know and love, Lazy Boy. Earnings of 20 cents a share missed by a penny, even though revenues topped forecast, as first quarter furniture sales were up 7%, despite what the CEO of Lazy Boy called a challenging retail environment. The board of the company also okayed plans to purchase up to 5 million more shares in the company. Shares initially fell in after-hours trading, as you see there, but they closed the day higher.
Steve Ballmer is out at Microsoft. The longtime chief executive of Microsoft and the new owner of the NBA's Los Angeles Clippers has resigned from the board of the legendary tech company. This ends a 33-year career with the world's largest software maker, where he was one of the original employees hired by Bill Gates. He's still the largest individual shareholder at Microsoft.
Still ahead, on the 10-year anniversary of Google's going public, its shares are up more than 1,300%. Is the stock still worth buying?
A milestone birthday for Google today. It sold stock to the public 10 years ago. On this special occasion, the company's reportedly going after a new demographic, kids. According to the Financial Times, it's planning to offer children under 13 their very own Gmail and YouTube accounts for the first time ever. Parents will have control over how the services are used.
We know Google bought out YouTube 8 years ago, and of course, we all know Google from its online search business, which many of us use every day. But Google's footprint is a lot larger than just online searches. Josh Lipton takes a look now at just how ubiquitous Google has become in our lives.
When you think of search, you think of Google.
I use Google for everything. Google Docs, Google Drive. Mostly GChat, the Drive, and Google Documents.
Almost all the things that are coming in Google.
I have an Apple phone, but I still use the Google software because the maps are better.
There are 3.5 billion searches every day.
Okay, Google now.
But there's more to Google than meets the eye.
Navigate to the Golden Gate Bridge.
If you have a smartphone, chances are you're using Android, Google's mobile operating system.
Navigating to Golden Gate Bridge.
Android will run on 80% of smartphones sold this year, according to IDC. Been to YouTube lately? Google bought that company in 2006. It now generates an estimated $5.6 billion in gross revenue per year. And thanks to Google, the days of paper maps and those bulky GPS units are long gone. So what's next for Google? At the company's developers conference in San Francisco earlier this summer, Google said it wants everybody using its operating system, whether they're at work, at home, even in their cars. For Nightly Business Report, I'm Josh Lipton in Mountain View, California.
Paul Meeks has been a big believer of Google and its stock. He's portfolio manager and head of technology research at Saturna Capital. Paul, nice to have you on the program. I know you're a big believer in the stock. You say that if someone is going to start a portfolio from scratch today, one of the first stocks that they should buy is Google. But at $596 a share, it's hard to see like how much a return you're going to make on that investment. So make a case about why someone should buy Google today.
Well, first of all, even though the company's been 10 years since it's been public, it's still growing at a pretty rapid rate. I think for the next couple of years, both the top and bottom line will continue to grow at 15 to 20% per annum. And next year, on December 2015 earnings, the stock's trading when you adjust for cash at about 17 times earnings, and it's going to grow its earnings that year 19%. And so this is actually a one peg or sub one peg ratio stock, which is very compelling for a company in the technology space or elsewhere.
Paul, do they have a sufficient moat around their various businesses?
Tyler, it's a great question that you ask. They started dominating search on the desktop, and they've extended that dominance with Facebook on the mobile application. And I also think over time they're going to see a wonderful growth driver in what we call the Internet of Things.
What does that mean, the Internet of Things?
Now, about a year ago, they acquired a company called Nest Labs. And so what this will do is link very mundane apps in your life, not even non-technology apps, to the internet, and it'll really change your life. And it could be a monstrous market.
Mm-hmm. Yeah, let me just follow up on that a little bit. When we think of Google, we think of it as the king of tech, a real innovator, a risk taker. It has a lot of cash. It attracts some of the best technology talent in the world to the company. But that's what it's been for the last 10 years. But looking at the next 10 years, can it continue to dominate the technology world? We've seen other companies dominate, like I'm thinking of IBM or Microsoft, and then it didn't continue that way. What about Google?
I think Google has as good a chance as anybody else. It's tough for a tech analyst and portfolio manager like me. I've been doing this almost exclusively since the late 80s to say that they'll never slow down. I do think that they do have some runway for that 15 to 20% top and bottom line growth for several years. Now, the interesting thing about this company, unlike some of the tech titans of the 80s and 90s, it has already in 10 short years reinvented itself 3 or 4 times. So I feel very strong about their vision and their execution, and I think that they'll do well for the foreseeable future.
So you own the stock. I assume you would add to the stock your holdings at these prices. Which shares would you buy, the A's or the B's?
So first of all, I would buy the A share because that's the share class, GOOGL, that is most shareholder friendly. And what I would do, the stock trades 590 plus. Earlier this month, so not too long ago, earlier this month, it traded at 570. I think that's an interesting place to nibble. And the best place to buy more is where it's really shown great support over the last couple of years is a 200-day moving average, and that price is 564.
Mm-hmm. Real quickly, do you think that Google will ever pay a dividend?
I think that they will, but in the near term, I'm pleased that they don't because they have enough opportunities to reinvest their cash flow in high return on investment projects. When you see a company, particularly in the tech sector, start to pay very lavish dividends and buy back a lot of stock regardless of how high the stock has risen, then they're probably in mature or slowdown phase.
Very, very quickly, what's the biggest risk it faces?
I think the biggest risk, Tyler, is that I'm wrong and it fails going forward to continue to recreate themselves, to continue to be visionary, and they miss the next trend.
Mm-hmm. All right, very interesting conversation. Paul, thanks so much for joining us. Paul Meeks at Saturna Capital.
Thank you.
All right, since Google began trading 10 years ago, shares have risen an astonishing 1,300%. But here are 10 other stocks, 10 others that have done even better over that same time frame. See if you can guess some of them. Top spot, Keurig Green Mountain, the company behind those K-Cup coffee pods, up nearly 8,000%. Energy drink maker Monster, online travel site Priceline, both up more than 6,000%. Then there's Apple, and then there's Alexion and Regeneron, up more than 4,000%. And rounding out the list, Netflix, Intuitive Surgical, Salesforce, and Western Digital. I hope you all bought them a decade ago. And Elizabeth Arden posts its biggest quarterly loss ever. And that is where we begin tonight's market focus. The beauty products maker didn't blame the weather or a consumer funk like some other retailers. It said Justin Bieber and Taylor Swift weighed on its results. I'm not kidding. A sales decline in celebrity fragrances, particularly from those two singers, hurt revenue. Shares plummeted 23% to 15.05. And shares of Salix Pharmaceuticals spiked on a report that Allergan has approached the company about a possible acquisition. According to that report, Allergan is in talks with more than one acquisition target, and it could strike a deal as early as next month. Now this, as Allergan, the maker of Botox, battles that $53 billion hostile bid from Valeant Pharmaceuticals. Salix popped 15% to $160.80. Shares of Allergan also up about 4% to $161.82. Skilled Healthcare and privately held Genesis Healthcare have agreed to combine. The all-stock transaction will create one of the largest operators of long-term care facilities in the United States. The combined companies will be called Genesis Healthcare, and it will trade on the New York Stock Exchange. Shares of Skilled Healthcare jumped almost 20% to $7.37. And PetSmart popped toward the end of the trading day on a report it may soon announce its intent to explore strategic alternatives, including a potential sale. Several shareholders, including the activist investor Jana Partners, have pressured the pet supply retailer to sell itself. The stock was up almost 2% to $69.70.
Sprint is upping the ante with its new mobile plans. The number 3 U.S. carrier unveiled a new pricing plan that offers 20 gigabytes of data and up to 10 lines for $100 a month. This will replace its Family plan and offer customers more data for the money than plans from Verizon, AT&T, and some of T-Mobile's options. But shares of Sprint fell 4% to $5.39. BHP Billiton is planning to spin off $16 billion in assets to shareholders in the form of a new company. The move is an effort by the mining company to focus on its most profitable assets. But investors were disappointed that the company is holding off on a share buyback. That sent shares down almost 4% to $70 and change. Soon you'll be able to wake up and smell the McCafe at home. McDonald's plans to start selling its packaged coffee at supermarkets across the country by early next year. The fast food chain is partnering up with Kraft Foods to make and distribute the coffee. Shares were up slightly to $94.57. And a milestone for Apple today. The tech giant hit $100 a share for the first time since its 7-for-1 split back in June. Shares held on to that gain, closing at $100.53, a gain of more than 1%.
Well, sometimes a good idea with the best intentions doesn't always work out the way you might have anticipated. And last month, we told you about new rules proposed by the Securities and Exchange Commission designed to stop runs in the money market mutual fund industry. Well, today, the Federal Reserve Bank of New York says those very rules could actually incite runs. New York Fed economists say giving funds the ability to limit outflows when liquidity runs short could actually make investors pull their money out sooner.
Coming up on Nightly Business Report, how the Ice Bucket Challenge may be doing more than making a philanthropic splash. It could also change the way people donate to charity. That's next. A big American company is defending a planned acquisition and tax inversion, despite a lot of criticism from Washington about dodging corporate taxes. We're talking about medical device maker Medtronic, and it says it's, quote, fully committed to completing its $43 billion deal to buy Ireland-based healthcare products company Covidien, and then reincorporating in Ireland to lighten its tax burden.
Well, Medtronic is one of about 50 U.S. companies using these inversions to reduce their tax bill. bills. And now the U.S. Treasury is taking steps to block companies from reorganizing overseas. Joining us now to talk about what the administration can do is Andrew Friedman. He's the founder and managing partner at the Washington Update. Andy, welcome, and happy birthday, by the way.
Oh, thank you, Tyler.
You're very well. We're so happy you're spending your birthday with us.
Happy to be with friends, yes.
All right,
I feel the same way.
Let's talk about what the administration can do. I gather that their palette of options is relatively limited to end these inversions.
I think you're right, Tyler. I mean, this is not the first time we faced inversions. These came up a number of years ago, and Congress gave us very particular rules saying that if a company merges with an offshore company and 20% at least of the shareholders after the merger are foreign entities, foreign people, then it's a good inversion. And there's no regulations that allow Treasury to do much to stop that. It really takes congressional action.
All right, so what can Treasury or the White House do in the meantime, whether it's a partial fix or not? What exactly can they do to change that and disincentivize American companies from doing these inversions?
Well, there's a couple things they can do, Susie. First of all, there's jawboning. I mean, the president has made it clear that these companies leaving the United States is unpatriotic. And believe it or not, that's having some effect. Walgreens is suggesting maybe it won't do that. Companies that get a lot of money from the IRS, say through Medicare reimbursements, are going to be hesitant. The second thing is that inversions is kind of the cake, but there's big icing on this cake, and that is once a company inverts, it can have the foreign parent loan money to the U.S. subsidiary, and the subsidiary pays interest out of the United States back to the parent, and that interest is deductible. This is called earnings stripping because it lowers their earnings here in the U.S. And their Treasury does have a lot of authority to say those aren't really loans and that isn't really interest and the amount shouldn't be deductible.
That's really a payment of equity back to the company that should
exactly
should not be deductible. Could the federal government say to these companies, you mentioned it with respect to Medicare and Medicaid, could the federal government say to these companies, if you do this, we're not going to do any business with you, we're not going to have it, you're not going to have any federal contracts?
Absolutely. In fact, some senators have asked the president to do just that. Issue an executive order and say, if you're going to move out of the U.S., you're no longer going to do business with the federal government. And that is, again, something that can force those companies to rethink moving offshore.
How big a problem is this really? And we just reported that about 50 American companies have done this over the last decade. It doesn't sound like a whole lot. Is this more headlines or is this a real serious threat to the U.S. economy?
I'm not so sure it's that big a threat, Susie. You might have seen the article in Reuters yesterday, which looked back at all the companies that have inverted, and it turns out their earnings have been lower since the inversion than they were before the inversion. Now, that may not be because of the inversion, but it's certainly not a panacea that's giving companies wonderful earnings. I'm not sure it's that huge a deal, but if you really want to address it, you address it with tax reform. You lower the corporate tax rate here so companies don't want to move offshore.
But the effective tax rate for corporations is low. It's not comparatively with others. It's not the nominal or the stated rate. It's what they pay when all is said and done, right, Andy?
Right. That's right, Tyler. But the reason it's low is because companies are moving their operations overseas. So we had the Apple CEO testify last year in Congress. Mm-hmm. They've moved all their manufacturing overseas. They've lowered their effective tax rate. So it means that they have less U.S. earnings and they're paying less U.S. taxes.
All right. Once again, happy birthday, Andrew Friedman with the Washington Update.
Take care now.
You've probably seen the video of the Ice Bucket Challenge. This is a clever campaign to raise money for research into ALS, better known as Lou Gehrig's disease. But is the popularity of the challenge a one-time gimmick, or does it mark a fundamental change in the way charities will raise money in the future? Robert Frank takes a look.
The Ice Bucket Challenge has become one of the biggest sensations ever in the charity world. It's raised over $22 million over the past 3 weeks. That compares with $1.9 million during the same period last year. These donations come from 453,000 new donors, along with existing givers. And it's not just Facebook and Twitter users. It's also many of the top CEOs and leaders, from Microsoft founder Bill Gates, Amazon CEO Jeff Bezos, to Facebook's Mark Zuckerberg and New Jersey Governor Chris Christie. The question is whether this is just a one-time gimmick or whether this will change the entire business model of philanthropy. Americans gave $300 billion to charity last year, and most of that still used the old model. But the Ice Bucket Challenge could change all that. Charity experts tell me that this shows the power of social media and attracting mass donors rather than relying on a few rich patrons. It's also added an element of fun to fundraising, and it shows that nonprofits can support a campaign without controlling every detail. Yet the bucket challenge is starting to create a bucket backlash, and some charity experts say it goes against the core values of giving to solve serious social problems. The stunts may overshadow the cause. Many people have watched videos and still don't know what ALS is or have given money. And this money may be a one-shot donation that's not repeatable. Either way, the Ice Bucket Challenge has thrown some cold water on old notions of fundraising. For Nightly Business Report, I'm Robert Frank.
And finally tonight, imagine a world with no Nutella. If you're nuts about that delicious hazelnut and cocoa spread, as my 8-year-old Mackie is, you may want to start stocking up. That is because there could be a shortage of the popular treat after bad spring weather in Turkey wiped out more than half of this year's worldwide hazelnut crop. Hazelnut prices have been soaring since a damaging frost this past March, now at a 10-year high. If there's no Nutella, my son is just not going to eat.
You're going to run to the grocery store right after the show.
I'm going to stock up right now.
Stock up.
I'm going to get jugs.
That's Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for joining us.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. We'll see you tomorrow. Eat your Nutella.
I'm Susie Garib with a Nightly Business Report news brief. Housing and Home Depot were the two big boosters on Wall Street today. Housing starts surged nearly 16% in July, while Home Depot earnings went through the roof as people fixed up their homes and yards this spring. Home Depot stock hit an all-time high and was the biggest gainer in the Dow. Investors were also in the buying mood thanks to inflation staying in check. The Dow was up 80 points, the Nasdaq rose 19, and the S&P added nearly 10 points. After 33 years at Microsoft, one-time CEO Steve Ballmer, who just bought the NBA's Los Angeles Clippers, has resigned from the board of the legendary tech company. And McDonald's will begin selling its own brand of packaged coffee at supermarkets starting in January. Be sure to tune into Nightly Business Report right here on your public television station.